Good morning, ladies and gentlemen. Well, the risk dial is turning slowly positive, but it's going to be a very long time before it gives us a buy signal, probably weeks. And what I said the last few weeks still applies. This is the worst possible time to hold much risk, whether it be in bonds or in equities. And let's examine what the charts are saying and why that could be so. Before we look at the charts, let's have a look at a few fundamentals. This is the five-year forward inflation expectation rate, and it's zooming higher. As you can see, it's now at the levels that we last saw back in, was this late April of 2024, and then again in middle of July of 2024, and really at the same level as we saw towards the end of last year. And it's basically as high as it's been this whole year. If we look at where real rates are beginning to now go towards 2%. It really would not surprise me if we were to go towards 2% in the very near future. And term premia are rising without a shadow of a doubt. And they could easily touch the 40 basis points or higher within the next couple of weeks. Now, let me tell you the way I think the bond market works. The bond market discounts before any other market, I think. And we all know that we have the elections in 3 weeks' time, just over. And to me, it's unlikely that the bond market is going to just stick around and wait for a Trump victory that it thinks. Now, I have no idea whether this is justified or not, and nor does anyone else, but the bond market is going to move first and ask questions later. It just does not know what the policies are going to be and how big the budget deficit is going to be. In those circumstances, as I said, the bond market is going to move first and ask questions later. And the move has to be one where it thinks that the supply of securities at the long end is going to increase, and that therefore the term premium are going to increase, and therefore inflation expectations are going to increase. If nothing else, because Trump has said that he will put pressure on the Federal Reserve to cut more, and therefore all these factors are steepeners. So what is the risk between now and the election? The risk has to be a big steepening of the yield curve before these policies are enacted, not after the election. So the risk to me is in the next 3 weeks. It's not on week 4. So now, having said that, let's have a look at the yield curve. Well, it stopped flattening, and the flattening was just basically a bounce from oversold levels, and now it's going back down. If it goes through minus 19, it goes to minus 28. There's absolutely no doubt in my mind. And it could go all the way to minus 42. Now, just look at 2s10s all the way back. I really would not be surprised if at some stage it goes into the hundreds. That is where the curve normally is. It's somewhere around 100 basis points of normal curve. And these levels at minus 10 are like nothing compared to where a normal curve is. So don't think it can't go a long way from here. Now, given that the Fed has said what it's going to do, and we have their dot plots, and we know how much they want to cut, and we know where inflation is, and we know that it's roughly stable, and we know a lot of things about where the short end should be. That gives us an anchoring point for the twos. And the twos are unlikely really to move very far from where we are. Okay, so the twos are here. Why should the twos move up a lot? Yes, they can always move 10, 15, 20 basis points on the back of data. But I think the path for the twos is pretty much set. They will either remain here within 10 or 15 basis points, or they will start going down again should the economy start weakening. Now, in the next 2 weeks, I would argue that the twos are not going to do very much at all. Up, down, but this 4% area is not going to be where they are very far away from. Now, that gives us the only possibility how the yield curve steepens is if 10s and 30s go up in yield quite a bit. So how is the 2s 10s going to steepen by 20 basis points if the 2s are doing nothing? Well, we have 10s at 428 and higher. This kind of level seems favorite to me, 435. And we have the 30s up at something like this level, the 460 level. So that is how the yield curve steepens. Now let's have a look at 2s 30s and see what the picture looks like there. You will remember that in August we had this move here, and this brought a lot of volatility to the equity market. And then we had a correction, and then it went down. To me, if we start breaking these lows, we will have the same volatility in stocks as we had in early August. And we'll look at that later, but just bear that in mind. That is what I'm seeing. So 2s 30s, and let's have a look at where they can go. They can go all the way down to these kinds of levels at around 125 basis points. So really, 40 odd basis points is really nothing much in a historical context. And having broken these levels and say that you get a move which is equivalent to this move on the downside, so this is, call it, 20 basis points to 180, that's 160 basis points to the downside from here. That gives you around 140, 150 basis points as your target. Now, that is a big steepening, and I really don't think it comes from the short end moving up as well. I think it comes all from the 10s and 30s, while 2s do much of nothing. Now this is now 2s 10s in Germany, and it's still steepening. And I'm showing you this because the German curve should be more advanced than the US curve, because they started cutting before the US. And we have another ECB meeting on Thursday, and they're likely to cut again. And this should steepen the curve even further. I think the German curve has another, 24 basis points of steepening until it gets to this 12 area, minus 12. And if the German curve is steepening as well, and the spreads are going out, and I'll show you that later, and this is now 2s 30s, and I think 2s 30s can easily come down here to minus 52, let's call it. So that's another just less than 20 basis points, right? Let's call it 20 basis points. That just tells you what the mood is. If even the German curve, which is much more advanced and doesn't have the election and doesn't have the issuance pressure that people fear Trump a Trump victory will bring to the US curve, and that is steepening, that tells me that the odds that the US curve won't steepen are very slight. And we're here to bet on good odds. And it seems to me that steepening in the US is very good odds at the moment. Another way I'm trying to triangulate these views is to have a look at the differentials. And as you can see, these twos, Germany, US, are now pretty stable. They got to where they needed to go. And that tells me that if Germany is not going to move very much against the US, that means that the twos US are not going to go anywhere. But then, if I look at the tens, you can see that they still have room to move to 190 or something. And that tells me that if the curves are steepening everywhere, and I showed you the reason why Germany is steepening, can go another 20 basis points, why would this spread not go to 190 and therefore give you even a bigger steepening in the US than in Germany? If you do the maths, you could easily see a 20-30 basis point steepening in the US. And all that happens here is that we go 5 or 6 basis points in this spread. So that tells me that steepening is very likely over the course of the next 2 or 3 weeks. I just don't think that the US market is going to wait for November the 6th and the results to steepen. I think it's much more likely to happen before the election, and then actually to have a bit of a rally after the election. That makes far more sense to me rather than waiting and hoping that it's not Trump or whatever. That makes absolutely zero sense to me. Because even if it's the Democrats, are they going to cut the budget deficit? No. So I think the bond market needs to send a message before the election to all these politicians, and the only way you can send that message is by steepening and showing them the power of duration. And if they don't take notice of it, it's going to run them over. Now, on Monday, first thing, and I don't think that that is very important at all for the US, we could have some disappointment that the stimulus from the MOF in China was not as expected, and therefore bonds rally slightly. This is TLT. I think any rally in TLT to this kind of level, around 95 to maybe 95.50, if it happens, is going to be a big opportunity to fade. So just keep these levels in mind, because after that, if it happens, I think that we go all the way down to 87 in a hurry. And that will be the message of the bond market to the politicians. I don't think that you can issue forever, and don't think that you can make the budget deficit anything you like, and do not think that you can issue that much at the long end. To me, it makes far more sense for that message to be delivered here rather than wait here for the election and then go. That makes no sense to me at all. That's not the way the markets work. I think it's far, far more likely that the market pressurizes within 2 weeks this 88, 87 level than just sort of trades around. Well, I think the Dixie has an appointment with this kind of level, 103.70, 80. It seems almost a given now at this time, because I think that tens are going to go another 5-6 basis points. So I don't think it's going to be a ridiculous move up, but I think this kind of level, a retest of this kind of level, 103.80, 103.90, is more likely than not. And that will get everybody absolutely bullsed up for the dollar. And I think that that's probably all she wrote. If we have a look at the Euro USD, that to me is this kind of level, just below the 200-day moving average, which is flat anyway, so 108.40s, but slightly above 108, and then we stop, and then we turn. I don't think that the dollar is going to go a million miles, and I don't think that it will respect differentials very much after the elections. Because after the elections, the game could very much turn to one of what is going on and why it's going on. And the dollar could actually weaken substantially as a result of that. I don't think it's going to be a game of differentials anymore for the first few months after an election, because it'll be a game of policy, changes of policy or not changes of policy. So all I can say is that I'm still playing the dollar long, but once I see the mid to low 108s, I'm definitely out, and I will do nothing until after the election. Gold is still doing absolutely nothing wrong. I keep on telling you the support is 26.15, 26.30, and where did it get to? It got to 26.20 and then went up. Now, the weekend move, could it be reversed because nothing happened in the Far East, or the Middle East? Yeah, of course it could. I still favor an ABC down, simply because if the yield curve steepens, that means that real yields go up, and they go up another 20 basis points, as I showed you, back to 2%. That should limit any upside in gold. And let's have a look at that. This is now gold over tip, and it's still rising, and it can only be because of Chinese buying. But I would favor a move back, or stability, or very, very slow up moves. So if we get a 20 basis point move up in real yields, I would expect gold to move up, to move down less than the real yields, and probably still remain in this kind of range, but a 20 move up in the basis points of the real would actually give you a lower price in gold, somewhere around the 25.50, 25.70 if you do the math. So I still think that the odds are good that we get another dip in gold. Of course, not as big as the tip, and then you buy it. That was gold tip. If I go gold TLT, it's much the same kind of chart, but less pronounced. I think that gold is going to go down far less than TLT, but it's still going to go down because TLT will go down more than gold. I think that is clear. So I would wait to buy gold, and I would wait for around a new low than the one we saw last week, around the 2600 area, and I think everybody there will get stopped out, and that will be the opportunity to buy gold again. DBC is becoming fascinating to me, because this period of stability that we've had all year, and let's have a look, where did we start the year? We started the year here, and really we've been in a range of 10%. 10% range in commodities is almost nothing. But this is the highest weekly close that we've had this year, and it's 23.79. Now, what would not surprise me is that we get a higher close than that over the course of the next couple of weeks, and that increases the pressure on long bonds. That would make a lot of sense to me, that we make new highs for the year and then we trade somewhere around 2440 to 2450. That would actually really chime in with what I've been saying about a steepening of the yield curve. Again, the first move on Monday is likely to be lower because of the Chinese news over the weekend. What's going to be the tell? The tell is going to be if it can't break the lows of last week, so around the 2260. If all it does all week is stay around the 2260 area and not breaks it, that I think is a tell, and it's much more likely to trade higher after that. So I will be buying calls if it just sticks around this 2260 area, or you could even be buying straddles at this 2260 area, because if it just keeps on coming down here and not breaking it, well, it's going to go big time one way or another. It's either going to go up here or it's going to break and it's go down to make new lows. So I think volatility at this level, 2260 on DBC for all commodities, is what I think is going to increase going into the US election. You could see very large moves off this 2260 area. Just a quick word about something that I haven't traded in a long time, but I love to trade, which is MSTR against BTC. We're coming to all-time lows with the sort of BTC bros or whatever they are getting very excited that MSTR is going much higher. Well, it's not going to go much higher without BTC. So I just want you to be aware that we are where we are and what happened in 2019 after we got to these levels and what the move was. So, you work it out what percentage this is. This is X4. So X4 your money. So be very aware of this, and I will tweet when we get down here and doing some options in MSTR. Again, some options in BTC is going to be well worth it. Let's start equities by having a look at my clean chart. And bear in mind what I said at the beginning of the video, what happened when the yield curve really steepened at the first few days of August. This is it. Okay, this is the move. And odds are that it happens or something similar happens again. Now, do I think it's going to be as brutal as that was? No, I don't think so. But it could definitely retest this 5670 area. And I would like it to break it and really stop everyone out and go to this kind of level, 56.17, and possibly touch all the way down to 55.68. Would I love to see it? I'd love to see it. I think it's going to be an opportunity to buy it, because I think the steepening after it's occurred, it's more likely to be a, sort of a get out of the steepener, and that is going to again provide support for equities. So I do think that the steepening will cause volatility again. We already have volatility high, but it could easily go higher, and that should pressurize the equities to go down, and that will be a buying opportunity yet again. And here is volatility, and this is a weekly chart and this is a daily chart. You can see how well it respects this 2279 on the cash VIX. What would I love to see? I would love to see a spike to 3011. So I would love to see a spike up to here over the course of the next couple of weeks, because I think if that happens, that will be a great opportunity to buy equities and probably sell VIX. I definitely would prefer to buy equities than to sell VIX, but I think that that is likely to happen. This move is likely to happen and will be the climax of the higher volatility story that we've had for now, I don't know, all just about 2 months. We're coming into the election just like bonds are likely to steepen before the election. I think volatility is likely to top before the election. So here we now have SPX, and it's basically just wedging, just as I thought it would, all the way up to the top Bollinger Band on the weeklies and coming back down. It's just wedging up. Where does the Bollinger Band come in next week? It comes in around 58.75. I would love to see that, and then I would love to see a move back down towards this 56.50 area. I think before the election, somehow people need to be shaken out of their longs in equities. I still think that longs in equities are far better than longs in bonds, but if we get this steepening that I would bet on, because I think the odds are very good, it has to impinge on volatility, and that has to impinge on the price of SPX. It might be less than it happened during August when we had this move, but I think it's likely to happen. And really, the minimum I can see would be this around 56.25, 56.50 area. That would be the minimum that what I would see equities coming off by, because it's not very much, it's a few percentage points. I think it's very unlikely that we go into the election at the absolute highs. To me, that doesn't make much sense, just like it doesn't make any sense to me that volatility is at its highest the day before the election. It should be way coming off by then. And that tells me that we should really have a move in the next couple of weeks down, which is buyable. If I'm being absolutely logical, the steepening should affect the high beta stocks most. And you can see that actually NQ and NDX have gone up the least in this move. They're nowhere, they haven't, all they've done is not even fill the gap up to 20,400. All they've done is sort of like retraced. And what I would love to see is a fill of this gap here at 19,300. That would be wonderful, because that would mean to me that A, the yield curve is steepening and NDX is reacting the most, B, that volatility is going up, and C, that we are likely to see those targets in SPX that I just mentioned. So that is what I would love to see. I would love to see 1,000 points lower in NQ over the course of a few days. Last thing I want to mention for you to have a look at is EEM next week. Because with the disappointing news from China, I mean, I have no idea whether it's disappointing or not. I know the market's going to be disappointed. We are going to probably retest the 45.04 level in EEM. And that is going to be another tell. Can we close the week below 45.04, or do we just keep on bouncing off it? It's going to be, to me, very, very important, because if we stay above it, this is going to turn the 200-week moving average, and then we are saying really that we are open to very, very big moves up in EEM. I think that doesn't make much sense for the time being, but maybe makes sense next year. So if it keeps on bouncing off this 4504, if it's, but I have no idea if it will or not. I know that I'm out and I'm not going to buy it up here. It's too soon and it doesn't make any sense. But should it ever come back down to 42.25, I think it makes so much sense to buy, leaps in terms of 1 year straddles. And I think, you can forget about the puts. I think 1 year calls at this level, at the 42.30, would make so much sense. So what to look for next week? Well, obviously the yield curve steepening, and the tell's going to be on Monday. And what is the bond market going to do on Monday? What kind of bounce are we going to have in the long end on the China news? If it's very moderate, I think that we put on the steepener almost immediately. And I've told you what the other tells are going to be, what DBC does. Does it keep on bouncing off support? Does it hold the support? Those will be all tells that the yield curve is going to steepen, probably 20 or 30 basis points before the election. So let's keep our fingers crossed that we get a good entry point in steepeners, because I think the risk reward there is extremely good. Thank you very much indeed, and tweet you tomorrow.